So you're retiring. You have saved money diligently for a long time. And one of the questions that's probably on your mind is, what do I do with my 401k? And one of the more common questions that I get asked, what do I do with my 401k? The thing is about it, most people, although it's a good question, most people mean it in the wrong way. It's really three separate questions or decisions rolled into one, and most people get them either they're only getting one or two of them, or they at least get them out of the order. So the first point of that question, I guess, or component of that question is, what is the custodian? Where does the money live? That's what most people mean, and it's by far the least important one. Like, does it stay in my 401k? Does it roll to a traditional IRA? That part doesn't actually matter nearly as much as the other components, which I'll get to. But that is usually what most people mean, and so I will go ahead and answer that part of the decision. The custodian, or the platform that it lives on, if it's in a 401k, whether it's at Vanguard or Fidelity, or if it's an IRA, wherever it's custodied, most of that part of the decision is whether it stays in a 401k or it's in an IRA. The part of the best analogy that I have is, imagine you have your kids playing on a beach. I just went to the beach with my daughter last week, and imagine that you draw a little artificial box in the sand and you say, here's where you play. Don't leave this box. You can do anything you want in this little box, but don't leave this box. That is the way a 401k works, essentially. You have a limited number of investment options. Now, the sand in that box is pretty similar to the sand everywhere else on the beach, but maybe there's something better somewhere else. And an IRA, an individual retirement account, moving it out of an employer-sponsored plan, opens up the entire beach of investment options. Now, in an IRA, you do have to be careful. Fees are different, and there's a reason regulation limits the investment options in a 401k, helps you not mess it up so much, so to speak, if you just don't understand what's going on. But it doesn't necessarily keep you from messing it up. It's just the theory behind it. And so this decision of 401k or IRA, most people, when they retire, will move it to an individual retirement account. There are some other differences than just that, but mostly that's the decision. The custodian is really just who holds onto the money. The only real important part of that first part of the decision is IRA versus the employer-sponsored plan. Most people move it to the IRA so they have control. They have more options, and in theory, there's really no fee to move it to an IRA. Now, moving it to an IRA does open up the possibility of many more fees, but in and of itself, it doesn't add anything. So that's part one. Two, what do I do with my 401k? What most people mean is, do I roll it over, do I not? Most of the time, roll it over, but that doesn't really mean that much. It doesn't actually change anything necessarily, very, very little. Number two, I would say it is whether, by far the most important part is number two, maybe number three, but number two is much more important than number one, that's for sure. What are the investments designed to do? That's the question that most people should be asking when they say, what should I do with my 401k? It's not what they mean. Because what they should be saying, what investments do I hold and why? Now, here's the really interesting, I guess, when you get to retirement, the answer to this question becomes increasingly nuanced, or the closer you get to actual distribution of your investment assets, the more nuanced the answer to this question becomes. There are many different angles you can look at it through, but I'll unpack a couple, and hopefully this is educational in the sense of like having a framework to think about the answer this question through, not necessarily arriving at an answer for you, but at least getting you a framework to think about your own individual answer. So how should you invest the money? If you're far from retirement, you only look through one of these, but if you're close to retirement, you have to look through the second one, and it gets nuanced. So there are two lenses, I guess you could say, or filters you have to go through in order to determine how your money should be invested. Thing number one is, how long do these dollars have to live? Thing number two is, how much volatility are you able to endure without shooting yourself in your own foot? The duration, or how long do these dollars have until you use them for something? If you're far from retirement, that one isn't really in play, because it's a simple answer. I'm young, I have 30 years, I'm not going to touch this money for a long time, so if I moved it to IRA or I kept it in 401k, that one is already established. When you get to retirement or you're close to distribution, say within 10 years, then definitely within 5, then the answer to how long do these dollars have to live starts to get nuanced, because some of the dollars are going to start being distributed soon, while some of them do have still a long time to live. And so there's a couple frameworks here that I will make videos on each of these and link them below. But the idea here is to set up your environment in a way where it makes you more likely to succeed. If you don't want to gain weight, don't have cookies in the cabinet type of mentality, you're just setting up guardrails. In fact, one of them I call guardrails, but the first one and the most common one that we use is I call it silos. I'm just country enough for that. Some people call it buckets. But the idea is a couple years worth of retirement income in silo 1. So it's somewhere very safe. It's guaranteed not to go backwards. It's not going to grow very much. Maybe just paced with inflation. Probably think like money market, CD, bond ladder, something like that. 92% of market downturns don't last more than 3 years. So if you have 3 years of cash, it's kind of a bridge across a market downturn. So that's silo 1. Silo 2 is, think traditional. If you go back in time to an advisor from the early 2000s, they have a 60-40 portfolio, 60% equities, 40% bonds, deaden out some of the swings. But you still have predominantly equities, so you're going to grow much more than super safe money. That might be 8 to 10 years worth of income that you need from your portfolio. So if you need $50,000 a year, that's $500,000 at most. At most usually. Then you have silo 3, which is very aggressive money. You're not going to touch it for at least 15 years. It can be very aggressive. You can go back in time, so to speak, and invest like you're young again, which means the money you in theory are rewarded. More risk, more reward, as long as it's a good portfolio. That relationship does exist. And so those silos, the first framework through which you would look through the lens of how long do these dollars have to live. Let's be intentional and specific and precise with which dollars have what job, what timeline do they have. I love that framework. Almost everybody that we work with uses it to some degree. That's the first one. The second one is guardrails. So a lot of people will ascribe to the thought process of the 4% rule or the 5% rule. What that means is if you have a balance of your money, and there's differences of opinions here, let's just go with 5% because it's a little bit cleaner math in the examples. We'll say you have $1 million. That means you can take 5% out a year and never run out. That's $50,000 a year, and it lasts in perpetuity. It's an outdated rule. It doesn't always work because people are living longer, and it's not quite as simple as that because you have things like taxes and inflation that throw it off. And it depends on how it's invested. But the idea here is relatively sound. It lasts at least for a long time, especially when it's coupled with something like the silos. It works really well. Say the 5% rule, $50,000 a year. What happens when you're actually living out this 5% rule? And this is the big gotcha. I wish I could just tell so many people living this out because we've had good markets for a few years. Is how often do you adjust 5% of what? So you have $1 million day one, 5% a year. Do you ever adjust it? Well, if the market crashes, maybe you should. If you're investing in all equities and you're $1 million, you took out 50,000, it's down to 950, and the market's down 40%. You're down to 630 or whatever it is, and you're in year 2 of retirement. You should probably consider readjusting that 50,000. So, of course, there are situations where you would adjust how much, the 5% of what. But then the question is how often, how big of a swing? Do you adjust monthly, yearly, daily? If you're doing it daily, you're going to get really sensitive to, or monthly, you're going to get really sensitive to market swings. And if you don't want to gain weight, don't have cookies in the cabinet. That line of thinking, which is we have to set up our environment in a way to help us succeed. If you're adjusting your 5% in too short of a time frame, then you are more likely to retreat into more safety than is in your best long-term interest. So you trade long-term security, growth in excess of inflation for short-term security, so that your budget this summer to go on vacation doesn't change. And that causes long-term problems. But if you wait too long to adjust your 5% or whatever number you choose, then you can have too big of a swing and you end up being at risk of running out. So The guardrails approach here is to have guardrails based on distribution. So in the $1 million, if you're doing 5%, we might say at 20% upswing, 20% downswing, we will look at adjusting your guardrails, but anywhere in the middle there, rest easy, don't pay attention, it's just noise. So we'll often combine those two frameworks, and there's many others, but those are two frameworks we'll use to kind of explain the logic behind assets that you would own in a retirement income portfolio, to answer the like how do we think about what you own, which is the most important question of your 401k. The second thing of how much risk can you endure of this part two is maybe the most important thing. In some situations it is. There's this thing, so if we have like really conservative money here and really aggressive money over here, a lot of people think of investing as a light switch, where it's either safe or it's aggressive and risky, but there's an infinite number of in between. It's more like a dial. You can turn up, you can turn down. And what happens so often is that people say, okay, I'm retiring, I'm going to retreat into safety, which may make sense. For a lot of people, it does make sense. But they retreat too far into safety, and if they turn the dial up just a little bit more, not all the way to being risky, but they retreat so far into safety, if they turn the dial up just a little bit more, that over a 30-year period with $1 million is like an extra $200,000. And it's risk that they happily would have endured, but because of a lack of precision, they didn't get that money. They just left it on the table. And so that risk tolerance thing is such a big deal. Risk tolerance is kind of eye rolly. It gets over talked about because it's like a compliance thing. Over talked about in a weird negative way. But it is a big deal to be precise about. So that's thing number two, which is number one, where is the money held? Like, is it traditional IRA, 401k, TSP, whatever? It doesn't matter that much. It does, but it doesn't matter that much. Thing number two matters so much. How is the money actually invested? I hope those frameworks help you, the silos, the guardrails, the volatility, and being precise with how much risk you have. That's thing number two. And then thing number three is, now I get it, there's a little bit of self-interest here because I'm an advisor, but it is a big deal, which is, should you, like, who is managing this money? So there's the initial and management versus selection of your assets. It's important to separate those. So selection of your investment assets, what ETFs or mutual funds or stocks or whatever, like what are you owning initially day one in accordance with these frameworks we've talked about. But then two is who is managing it on an ongoing basis based on what's going on in the world, the distributions that you're taking, market swings in this asset class versus this asset class, Roth conversions, all the stuff that you would do, who is managing it. For people with some amount of wealth, I believe it makes sense to have someone responsible for that for several reasons. The most important one for a new retiree or someone approaching retirement is that part of the lens that you want to go to retirement is to feel freedom. And that, like, most people don't speak tax language. They don't keep up with investment trends and changes of what's going on with what's available in the world. Structured ETFs are relatively new, and like just stuff. And so, or buffered ETFs, sorry. It's a bad example. Don't latch on to that one example. I'm just saying new stuff happens in the world of finance. And part of the lens of retirement is like relaxing and knowing that you're good and taken care of, and you get a paycheck. You know it's never going to run out, and you have extra money to spend, not to manage and worry, but to spend. That's why it's there. That's why you've been saving it. And so that lens is important, or that decision, is important. Do I have somebody manage this or not? And manage it doesn't mean just manage the investments. It's manage the plan, and the investments are part of the plan, or the tax decisions are part of the plan. And the plan is what do you want? Like, what do you want to do? What's your life look like? And in order to make that decision, it's something that's so important, and people don't take this seriously enough. You have to know, in order to get any service, you have to know, what am I getting, what am I paying for it? And if you don't know both of those things very clearly, then you can't possibly make the decision. So define those. Interview a couple different advisors, figure out what you're going to get and what you're going to pay, and like be clear on that so you can make the decision. I do think that it's almost always worth it to interview a couple different people. If you have like one close friend that you've trusted for years, maybe not, but even then, like, even the people that I'm closest to, I have very often recommended that they talk to someone other than me. So there's a little context. It's a lot easier to divorce an advisor than it is a spouse. But like, you don't want to go through that because it's hard. It's like kind of vulnerable to talk about money with somebody. More importantly, it's really hard for someone to know all the context necessary to be a fiduciary. It takes a long time, many meetings, and you don't want to waste that time with somebody that you don't want to work with for a long time. So those are the 3 decisions. Number 1, the question is, what do I do with my 401k? And there are 3 different decisions as in order to answer that. Number 1, who's the custodian? Where is it held? It's relatively inconsequential, but it matters, and you should take it seriously and be intentional. That's number 1. Number 2, what is the money designed to do? What investments do I have? That is relatively simple when you're far off, nuanced when you get close to retirement. And then number 3 is, do I have someone ongoing managing this plan as connected to the investments or not? I hope those frameworks help. I hope this helps. I'll make many more videos branching off these things, but one of the more common questions I get, and good luck. Follow for more.